So if you want this cash flow from your investments, this passive income to cover your investments, you got to know what it's going to take. And let's assume, for the sake of this example, that you want $40,000 a year to cover your expenses. $40,000 a year is just over $3,300 a month. So you want to make $3,300 a month in cash flow from your investments. Now we've got to figure out how to do that through dividends. Essentially what you got to do is you got to understand the different types of income there are. So there's active income, and then there is passive income. What you're going to do is you go to work every single day. And this is the active income that you're earning. This is your earned income. You go to work, you get a paycheck, you want to take some of this money and you want to put it towards your passive income, towards your passive investments, things that are going to pay you with cash flow. In this case, we're talking about dividends. So every time you get paid, you want to put a little bit of your paycheck, the more the better, towards your passive income. And now in this video, I'm going to be going over how and how much to get this $40,000 a year or $3,300 a month. That way now your dividend income can fund your actual lifestyle. The way dividends work, and I'm going to get more into this in just a minute, but you can take your money and you can invest it into a company like McDonald's. Now, McDonald's is a very established company, and every year they have a whole bunch of profit, a bunch of cash sitting in their bank account. Now, when they have this cash in their bank account, there's three things they can do with this cash. They can save some of this cash for emergencies, they can put this cash back into their business so they can grow faster, or they can give this cash back to their investors, people like you. So what they do in this case is they say, well, we have so much cash in our bank account that we have no better use for this cash in our own company, so we're just gonna give it away to our shareholders in the form of a dividend. So every year, or actually 3 times a year, McDonald's sends out a check to all the shareholders, people like you, people who own their stock, and this is what a dividend is. So a dividend in this case is every 3 months you get cash deposited into your bank account because McDonald's has paid you a dividend. It's completely passive. You don't have to do any work to flip burgers or any of that. If you own the right shares, now these companies will pay you with this cash flow. The reason why dividend investing can be so attractive to some people is because you don't need a ton of money to start investing in dividend stocks. Like you can start investing in dividend stocks for as little as $100. You can compare that to investing in real estate, where you're not going to buy a property for $100. So if you want to start investing in dividend stocks, start generating this cash flow from dividends, it's a much lower barrier to entry. You can start with $100 a month or whatever money you have, and you can slowly let this compound. And at the same time, if you invest in a strong company, hopefully the stock price will go up. And as the stock price goes up, hopefully the dividends will go up too, because as a company makes more money and their profits grow, they'll be able to send out bigger checks to you. So if you invest in the right companies, you can win in a few different ways because you'll get bigger cash flow every single year. And the value of your stock, your investment, is also going up. Now, if you really want to understand what it would take to replace your income, in this case, assuming $40,000 a year with dividends, you got to understand what kind of dividends are out there. Now, I do got to give you a little bit of a disclaimer here, because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so you should always do your own due diligence and never blindly listen to a random guy on YouTube. And everything I'm talking about today are just examples. I'm not telling you what to invest in. I'm just showing you how the process works. So you want to always do your own due diligence, okay? Right now, at the time of me recording this video, McDonald's is paying a 2.3 annual dividend yield. Now, this can change with time, but this is what it is right now. If you wanted to invest money into McDonald's right now and make $40,000 a year in dividend income based off of this dividend rate, you would have to invest $1.7 million in order to get $40,000 a year in passive cash flow through dividends in McDonald's. Now, I know this is going to seem like a lot of money, but I'm going to show you how you can accelerate this. EIX, this is Edison International, the electricity company. They pay out right now, at the time we're recording this video, a 4.5% dividend yield. So if you wanted to get the same $40,000 a year in passive income through EIX, you would have to invest right around $888,000 into this company today based off of this 4.5% yield to generate $40,000 a year passively. If you wanted to do it through IBM, which is right now, at the time of recording this video, paying a 4.8% yield, it's going to cost you $833,000. And AT&T right now is paying a 6.9% yield. And if you wanted to get the $40,000 a year, it will cost you right around $580,000 today. Now, there's a couple things that I want to point out with this. One, this is not something that you have to just do today. If you want to build this cash flow, this dividend income, it's going to take time. And the way you want to do this is by every single month, every time you get paid, you want to put some money towards your investments. And the best way to do that is automatically, that way you don't accidentally forget to do it. But you want to consistently keep investing your money into these stocks or whatever dividend stocks you're looking at if your goal is cash flow, because now what you're doing is every month you're just building up this machine that's paying you. Maybe right now you're only making $5 a month, but over time that's going to grow to $50 a month, then $500 a month. And so you got to understand that this dividend cash flow isn't something that just happens overnight. It's something that takes time. It's something you got to build up. So you got to get into the habit of understanding that every time you get paid, some of this money has got to go into your cash flow producing machine, your dividend stocks that are going to pay you with income. The second thing that I need you to understand is the risk. Because let's just say, for the sake of this example, that you look here at AT&T and you say, AT&T is paying the highest dividend, so I'm going to invest my money only into that company. And so now for the next 10 years, you keep investing some money into AT&T, but then AT&T goes bankrupt. If that happens, now all of this money that you put into it would disappear because this company just went down the drain. And now this wasn't your fault. It was the executives at AT&T that ran the company into the ground because you were just hoping to build this money printing machine. But the executives at AT&T didn't do a good job, so now you have to pay the price. So you got to understand that there is risk here. When you invest in individual stocks, you take on all the risk. So there are ways for you to mitigate that risk. Number one is by doing your research. If you want to invest in individual stocks, you have to keep up to date with the company. You have to read their earnings calls. You have to read their financial statements. You got to see how this company is doing. Because if you start looking at a company and you see the revenue starting to drop, you see the profit starting to drop, you see people not liking this company so much, then that's a red flag that you want to pay attention to. But if you don't want to really do all the work, then you shouldn't be investing in individual companies, individual stocks. Then what you want to be doing is investing in funds that give you exposure to dividend paying stocks, because there's something called ETFs, which stands for exchange traded funds, which give you exposure to a whole basket of stocks. So now instead of you trying to find the best companies to invest in, you can invest in an ETF, which gives you exposure to a whole bunch of dividend paying stocks. That way now, if one company goes bankrupt, you're okay. There's a whole bunch of other companies in there that are still paying you with cash flow, with dividends. So if one company goes down, you don't lose everything. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.